The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody. Welcome to our webinar today. We have very proud to have CC Yong online today. We've shared with us what is the strategy to trade FCPO. Now, today we're going to talk about palm oil future trading strategies. In the next 90 minutes, our speaker will share with you his experience and case studies on how he can trade palm oil futures profitably and for a consistent basis. Now, as usual, disclaimer, whatever we share today is on information, is for educational purpose only. So you are financially responsible for your own trading loss or trading profit. And then we have planned a series of webinars for you in the next few months. So the first one was last week. This is the second webinar, which is this Wednesday. And then we have KLCF future trading strategy for outright strategy, which is 18 July. For FCPO outright trading strategy is 15 August. And then we also have technical analysis in FKLI and FCPO. Those in red colors are the one in Chinese versions. All right. So for those of your friends who want to learn in Chinese, you can ask them to join our webinar 7 to webinar number 10. All right. Okay. So just want to check if my audio quality, you can hear me right. So if you can hear me clearly, could you please raise the hand button? All right, or you can see me, please click raise the hand button. All right, excellent. So now let's begin. So now I want to introduce our speaker today. If you follow our last session, he is no stranger to you. His name is CC Yong. He's a full-time future trader. He's currently on the screen right now on the webcam. So he's a local participant of Bursa Malaysia derivative. To be a LP, local participant, you need to trade at least 1,000 lots every month to qualify for it. So he's somebody who has traded a lot of contracts on Bursa Malaysia and made it really big. Okay, he's the founder of Straits Index, a proprietary trading company and associate participant of Bursa Malaysia Derivative. He's a trader, trainer, and writer, speaker for SIDC and various financial institutions, and also a columnist for Sinchu Daily, United Daily, Money Compass for more than 10 years. Without further ado, let me hand it over to you, CC.
Hi, Chusan. Good evening to everyone.
Good evening. It's very glad to have you on board here.
Yeah.
Okay, great. You're in charge now.
Okay. All right. Good evening. So thanks, Johnson, for the introduction. So today we're going to talk about one of our, we call it class or our star contract in Malaysia, in Bursa Malaysia derivatives is the crude palm oil futures. So let's take a look. What is this? Okay. This palm oil futures is actually because it's actually derived from the palm oil, but CPO actually stands for crude palm oil. So FCPO actually is the futures of CPO. So basically, we talk about the CPO and then we derive this to a strategy called spread trading. And overall, palm oil is actually the most consumed edible oil in the world. And this future contract, the CPO is actually the benchmark of palm oil in Asia or Asian time zone. So that means during Asia time or during the daytime of Malaysian time, so this will be the benchmark contract, which people are actually looking at this contract for price discovery. And the CPO is also very active in hedging and arbitraging. So CPO is active also in spread trading because actually this is one of the most active calendar spread trading contracts in the world as well. So we run a series actually to explain this, and we call best kept secret of this or FCPO trading. And this spread trading is actually very robust. It is very active. I'll show some slides proof that it's sometimes even active than the outright trading, and that's why we call it a best kept secret for many years. So let's move on to the next slide. Okay. So basically, a future contract needs an underlying asset. So the asset is actually a CPO price. CPO price is the crude palm oil. Okay, CPO are not the edible oil yet. It's a processed oil from the fruits. But it's still actually I consider raw. You need to really like refine and bleach and deodorize to get the edible oil. But this asset or this underlying asset is actually classified as an underlying asset for the FCPO contract. So, for example, if the CPO actually run in certain tandem, the FCPO will actually follow the price. This is actually the ideal contract situation. But of course, in reality, this is not the case, because nowadays futures contract is actually supposed to be following or tracks the physical crude palm oil prices. But actually, the physical traders or those who actually import and export the crude oil, okay, they also tracks the benchmark futures, which is usually the third contract month of CPO for price discovery. That means you should be looking at the physical price, but in turn, the physical trader also look back in the futures price. So somehow rather, the futures price become the benchmark, or everybody is actually looking at this price as the factor of actual worth of the crude palm oil. And the difference of premium and discount is added actually depends on the physical market conditions. So that actually eventually will form a very beautiful trading, or first actually is a price curve, and then from the price curve actually you can trade spread. But before that, let's go through slightly on the contract specification. This is very important because you need this element to calculate the contract size, contract value. Eventually you will control the risk. So I'll cover all this briefly before we go to the strategy. So first thing first is the underlying instrument is actually crude palm oil, and this means, and it's a physical delivery order, meaning to say if you hold a buy contract, let's say for example, or long contract of CPO, and it went to spot month and matured. Once it's matured or expired, you actually have to collect the oil. So if you're the seller, you have to deliver this oil to the buyer. So be careful on this, because this is actually a physically delivery order. And the contract size for this contract is 25 metric tons. That is the reason why you see every tick you move up 1 ringgit, your P&L will be up by 25 ringgit. This is because every 1 ringgit in the FCPO price is actually multiplied by 25 times. That's why you get the 25 ringgit. And it has got the spot month, which is the delivery month, and the next 11 succeeding months, and plus 36 months. This is just a newly added contract months into FCPO this year by Bursa, and actually it's very good move because it gives life to this contract, because nowadays you can trade the spread actually basically, or trade outrights of CPO up to 12 months in a single month duration. I'll talk about this in a little bit. And trading hours, I suppose you all maybe already know. So let's move on the next one. Let's get started in CPO right now. As I said, margin is actually a very essential element before you start trading, because when we talk about risk and all this, it's not only a P&L, it's not only the risk and reward ratio, but it's actually start with small thing like margin. So if you take a look at this slide, CPO RI margin is actually 4,500 ringgit. That means you need only 4,500 to actually control one CPO contract. But if you take a look at the specification, it also says spread is actually at 1,000. In fact, now actually spread increased to 1,002 recently, which you can see in the next slide. All right. From 1,000 actually increased to 1,002 on starting from 12th of June, which is this month. And outright is actually still maintained at 4,500. But it also means that, outright is actually one contract. That means every contract you go in, single contract you go in, you actually need to have 4,500 to maintain a contract, or we call a margin maintenance margin. But for spread, it's actually two contracts, okay? But you only need 1,002, which means spread has got much more margin effective, or in other words, why the margin is lower for spread is because the exchange itself recognize spread trading is actually slightly lower risk or much more lower risk compared to outright trading. But it actually doesn't mean that there's no risk, but it just means that it has got slightly lower risk compared to outright trading. So margin and risk are quite something related. So I usually need the audience to understand this before we really go in deeper. Is most of us actually trading stocks before. So in stocks or securities, if one invested a stock worth that 60,000, for example, so the cash or the capital that you needed is actually 6,000 also. So unless you go for margin or actually you finance by the company or bank or something, then you pay interest, then you don't need so much cash. But you need to qualify for that. But futures trading by default is actually you are qualified for the margin. Okay, that means you are using something smaller to control a bigger contract, which I'll explain here. In futures, only 4,500 is needed to control the one single contract, which is CPO or FCPO, but it could worth 60,000 as well. Assuming, let's say, for example, if CPO is actually priced as 2,400, multiple by 25 metric tons in the contract size, you get a 60,000 ringgit worth of contract. That means one CPO is actually worth around 60,000 at 2,400 ringgit for CPO contract. So if one is not aware of the value of these FCPO contracts, so you could actually face a frustration of P&L, okay, higher than his expectation. So this can be only overcome in the risk management. That means if you want to control your risk, then you need to deploy or employ some risk management in trading. So the margin and risk is actually true that you can hold a CPO contract with only 4,500 because this is required in the margin requirement for the exchange. But it's wrong risk management if you actually trade a contract of CPO with only 4,500 because you actually thrown the risk management of trading out the window because there's no room for you to move. Because it's very hard to predict the direction of the market. Actually, it's so hard. Although sometimes you can forecast, but do you know that actually forecasting the market is actually too difficult? Why? Because let's say, for example, if you have a long position, of course you want the market to go up. So your prediction is always that the market can go up. But once you have a short sell position, you mean your mind is actually setting that the market can go down. So you will predict or you forecast or you will see only the signal that telling you market going down. But once you have no position in your hand, then you will see things clearly and you start to actually forecast correctly. But if you can forecast but you cannot trade or you cannot own a position or cannot hold position, so what's the point? So since it's so hard to predict the market correctly 100%, so you need some room for your contract to move up or down against you, average down, So that's why you can't have traded one lot of contract of CPO with only the minimum margin requirement. So, but this is the most common mistake in trading futures. So I hope you understand this, and you need to calculate your position correctly in trading this futures contract. Now, in a nutshell, of course, I'm not going to go too detailed because we have only 1 hour. In a nutshell, CPO contract actually is 25 ringgit per tick or per point. So that's all. You remember this, every tick it moves, you make 25 or you actually lose 25. And the value of the contract will be the CPO price or FCPO price multiple by this 25 ringgit. So you get a 2,005, let's say 2,400 ringgit CPO price times 25 ringgit, you get 60,000 roughly. So you calculate your risk based on the 60,000. that will be a much better way to calculate your risk. So if you use 4,500 to control one CPO or FCPO contract, then you could actually lose more than 4,005, which is the initial capital. So this will be your basic understanding or elements that you must understand before you start trading this CPO. Now, how to manage risk? I always say that risk management is actually is the factor or is the element that actually of any successful trading story. If you don't have this, you can't trade and make money in long run in any trading actually. So it's very important to control this, okay? And risk control is, as I said, center of every successful trading story. And the control of risk exposed to every trade is actually crucial. That means every time you go in, you know how much risk you're going to face and trade with money that you can afford to lose. Because sometimes, let's say, your broker maybe allow you to trade 5 times of your equity in your account, but it doesn't mean that you need to do this, because you need to learn to control. I've seen my company, actually, I have so many traders inside. I've trained so many traders. I've seen so many people that they trade with the size that, you know, their equity actually cannot hold that size. That means they're over trading during intraday. Some say this is the features of futures, because you can actually, you know, lean on the leverage of futures using margin. But to me, this is a surefire formula for failure in trading futures. This should be actually avoided, especially when you're so new in or starting to trade or beginning to trade futures. Now, last year we ran through this risk management already. So we go through the basic element that you need to understand to trade futures, which is, you know how much you risk per trade. You must know that you must fix a figure, and you know your risk to reward ratio. That means how much money you're going to risk and how much money you could actually make. A conventional wisdom usually, you know, 1 to 2, 1 to 3. But honestly speaking, if I'm trading spread, I'm actually okay with 1 to 1. That means, you know, I can be losing 1 ringgit, but actually in order to gain 1 ringgit. This is actually the whole point of trading spread, or this is what the strategy is all about. And the winning ratio. Winning ratio is crucial. Okay, to calculate your winning ratio is actually easy. So try to get 100 trades of your past trading, okay, and calculate how many times you make and how many times you lose and how many times you actually break even. To me, winning means the one winning. The one that actually break even and lose actually consider not winning. So you must only take the winning ratio. You need to have a very high winning ratio. A basic requirement, if you start trading, 50-50 is actually your winning ratio. No matter how bad you're trading, you have 50% starting ratio. But for a good start, is actually you need to have at least 65 probably, okay, or 60% winning ratio minimum, and try to increase the winning ratio so that you have a very high expectancy or in your trading. So this is actually also crucial. And number of trades. Many people actually start trading probably nowadays. You backtest first. You know, you backtest using computer software, or you backtest using probably your eye, or you forward test using your paper trade, or you test with small money. This is actually crucial. But number of trades actually play also a very important role in trading. Is that if your formula or your signal or the way the system that you're trading, you have only traded probably 5 times, 10 times, and you make actually probably 80% of the time, and you consider this is a holy grail that you found by yourself, and you go for it, I will strongly against that, because you shouldn't. Because one should actually trade a lot, as I mean a lot, like if not 100,000, maybe tens of thousands of trades, or even thousands of trades, you know, as a bare minimum to consider yourself actually know how to trade. So this is actually an important element as well. That means any trades or system that you design, and it's only have one signal in a year, and it's only backtest for 10 years, you have only trades for probably 2 years or which traded 2 times only, that doesn't consider a good system. That will actually will be very much curve fitting, which is actually another issue. But let's focus on a few basic requirement or the risk management that very easy for you to start follow. Honestly, I know as a beginning trader or beginner trader, you can't have all elements at once. Usually, I myself make some mistakes, and then repeatedly, every now and then repeat the same mistake, and I tell myself not to do this again, please. And I do it tomorrow. So I've gone through all this like multiple times, and until there was a time that I realized I hardly actually have this issue anymore. So that was a time that you become consistent, you become more and more aware of what to do, and everything actually come in natural. So first thing to try out, I would suggest to you is actually, it is important to know, okay, how much you can actually risk in every trade. So I will actually suggest 1%. That means if you have 1% or any trade you go in, you shouldn't lose more than 1% of your equity. So if you have an account that have worth 100,000, do not lose more than 1,000 in every trade. This is like, you don't lose one marble in 100 of marbles. So that is actually a very simple rule, but it's definitely very effective way to do so. So future trading is actually has risk, okay, but it doesn't mean that the risk is actually much higher than other product. To me, future trading is actually not risky if you have adequate margin to withstand any whipsaw in the market, or not over trading. If one uses high margin leverage to trade security or stocks, the investment can be as risky as futures. That means even you're buying a house, buying a land, but you're using too much leverage. The leverage is the one that helps you to make money, of course, okay? But the leverage also is the one that helps you to, actually make you lose a lot of money. So use the leverage wisely. I know there's some leverage product outside, probably will be like 10, 20, 30, hundreds of leverage for certain product. But to me, if you can afford to use lower, the leverage is much better. So that is how it goes. So, but to me, trading CPO, it may be different than other people. I don't trade CPO like as in I see production slow down, stock low, so I'll buy CPU and hoping it go up 100 ticks or 200 ticks and sell it off. No, I trade CPU in a strategy called spread. Okay, what is spread? Spread is actually in today's actually we talk about spread that very popular in Malaysia. If you are amongst the full-time trader, I call it CS or candle spread. So candle spread, basically you buy and sell contracts expired in different months in the same exchange. So which is being, let's say CPO has got production or contracts that, let's say 12 months, first 12 months as of from now is you will have July, which is spot month, August, September, October, November, December, January, February, March, April, May. Okay, these are the 12 months contracts that you can trade now, and 36 more contracts, which is double month, odd month. So if you buy one of the month, let's say September, and you sell October, so one buy, one sell, and expire in different month. This is called spread. Okay, this is an arbitrage method of bull or bear market. The market is actually either up or down, right? Or sideways. Sideways is actually up and down, but in a very small range. So this is something like, you arbitrage it theoretically lah. So spread trading provides some liquidity also to traders or hedgers, because we show you some screen which you realize that most of the volume that you might see in trading CPU sometimes actually came from spread. And the spread trader actually also spread the risk across different calendar months, because this is the way we do it we provide some liquidity to the market, but we also actually spread the risk to different months as well. So the example of doing a spread trading will be, let's say you buy November and sell December contract at the same time. You can do it, one first and do the other second later, but usually the way I'm trading is actually I do it simultaneously. So before that, let me explain how a price curve works in spread, or to explain how this price curve, in order to explain the spread. Let's say, for example, here, you can see that CPO price is actually quoted in different month, right? So here we can see that, there's this day, okay, this is 1 day data, which is on the 12th of August. This is the different price. That means every single contract of CPO quoted in different prices. And the next day, price went up or down, depends on the market situation. And in all the contracts are not traded in the same price. So if you plot everything into one chart, okay, you get this kind of curve. And this is called price curve. And because they are never a flat line like this, they're never a flat line like this. So they're always different month has got different level, which is slightly different than the other one. So this actually makes spread works. Okay. For example, in this contract, okay, you can see that the spread price or the price curve are at different level, but how spread are actually priced, let me explain to you in a little bit. Okay, so spread price is actually you calculate with a futures contract value minus the deferred futures contract value. So for example, if January the price of a CPO is 2,510, and the next month which is February, the price at 2,500 only. So the spread of January and February is the first one 2,510 minus 2,500, which equal to 10. So what is the spread? Spread is actually 10, or 10 ringgit spread of January, February. And this is actually in a positive number. Let me show you an example in this. You can see that here I just took an example. Excuse me. Okay. An August contract, okay, it's actually priced at 2,312, and then the September contract 2,313. So what is the difference? The difference is actually 12 minus 13, which is -1. So that's why you can see the spread is actually -1. This is an August contract. This is a September contract, and the one in the middle is actually an August and September contract. So the spread is actually at -1. All right. So this is how spread prices are displayed and calculated. Let's move on to another slide. Okay. In this slide, you can see that on the left-hand corner, this is outright contract. Okay. Usually our prices are quoted at 2,300, 2,311. Okay. This is August, and September is over here. Now, if you have September, and then you can see that the price is also quoted in this manner. But in between, you can see that an August and September is actually here. So the August and September is actually showing you that the price is in spread. And do you notice that this contract has got the volume 2 lot, 2 lot, 2 lot, 2 lot, 8 lot, okay? September has got 8 lot, 12 lot, 7 lot, 11. But the spread contract has got 1,600 and 1,200 and 600 and 500. And here is actually about 400, 400, 400, 800, 1,000. The volume in spread trading, which the price is actually parked there to buy and sell, it's much higher than the one in actually trading outright. So that's why we don't be surprised. Spread actually, actually sometimes it's more than 50% of total volume traded in the whole CPO market. So we move on to the next slide from here. So why the positive and negative number? The positive number is because, let's say, for example, in this case, January is actually higher than February. So the spread is actually positive because near month is actually higher. Okay, you get a negative number if the first month is actually, let's say, 2,480 and the next month or the third month is actually 2,500. And this is actually 20 points lower than the next month. So 2480 minus 2500, you get minus 20. So that's how you get negative number. And spread, sometimes you have positive number, sometimes you will have negative number as well. So let's move on to one of the case study that we can see here. It's using the same example, okay, but this time we will try to build a spread and then see how spread goes. Okay, as you can compare, if you actually join our webinar last week, FKY has got no price curve that's so actually you can build like this because they have actually lesser contract months, but CPO you have a lot of months to play with. That's why your price curve is actually much more longer, vibrant than the FKY. So assuming if I do a contract or a trade, I want to buy October at 2241, but because it's a spread trading, so you buy 2241, I also try to sell something, and in this case I'm selling 2241 also for the December contract, which they are in this price. This is not actually done, but this is actually simulated trading. And the next day price went up. So if price went up, the one that I long, actually I make 81 ticks in this case and the one that I actually shorted because it went up also, I lost 61 ticks. So end up you actually only make 20. So how to get the 20 ticks you make is actually you make 81 ticks minus the one that you lost is 61 ticks. So you actually gain 20 ticks. Now this is your net spread profit. That means my spread actually make 20 ticks. Often I actually get this question asked. So if I know the price will go up, why don't I just buy October contract rather than I sell also? So I do a buy 2241 of October. I may make 81 ticks the next day. Now the question is, or the problem of why I need to do this, because I do not know the price will go up tomorrow. I wish I could have known, then I will buy 1,000 lots here. But in reality, I definitely have no chance to have predicted correctly the price will go up the next day every time. So because I don't know, so I have to actually do a short trade to actually protect my position if the price go against me. Because imagine this, if I have sold this 2241 initially, I could actually lost 81 points, which is a lot in trading, and I am actually lose money. So I can't allow this to happen. So if this trade actually I did a short or opposite, I actually lost 80, not 81, but I lost only 20 compared to the person who actually went in only nakedly or doing one directional. He could have actually lost 81 points, but I could potentially only lost 21 points. So if you are a trader, which one you choose? You choose the 81. I'll choose the 20 because to me, going for low risk is actually my goal. In order to make sure that I could actually trading and survive, because as a local participant, I need to actually trading to survive. That means my income actually came from my trading. So I need to have something that my risk is actually low. I could generate some income, and my salary or my life actually spend actually using the money that I make from it. So I will go for the one lower in risk instead. So that is why spread is actually working for me. And why people trade spreads? As I said, this is some of the reason. First thing first is actually reduce risk, because I just explained. Instead of I want to potentially lose 81, I want to limit my loss only to 20. This is just an example. And lower the margin, that means I could actually enjoy easier to start, because as I always say that, you know, it looks like spread actually only or usually are actually traded by professional or those who trade full time. But since the margin is actually much more friendlier, I also suggest that actually spread can be traded by the beginner or basic trader. And next is actually you will have higher return per dollar risk, because you are using 1,000. Everything you make is actually 25 ringgit. If you're trading outright, you need 4,500. Okay, but each tick that you make, you will also actually only make 25 ringgit. So which one is better? I think the spread will be better. Excuse. And to take gaps away from trading, I'll show this in one of the slides. And working in sideways market as well. Remember, there will be always some complaints that market sideways you can't trade, but spread trading is actually basically you're trading in sideways. So sideways is actually not our problem. So that's why we like to trade spread. So we don't have the time where sometimes the market are so bad or quiet that we can't do anything. And using spread, actually, you protect your outright position. That means if you're trading outright, you can actually convert your outright to spread. That means you do a long, suddenly the price actually went down 5 points, for example. You just short another contract, then you form a spread. Okay, and this spread will protect your position. If the market actually went up, down, 300 points, maybe your position not going to lose a single cent, you know, if you actually turn your position to a spread. And trading with strategy, okay? Spread itself is a strategy, and there's more strategy which I will just briefly touch a bit. And here is an example on trading spread. You know, if you're trading outright, you know, market can just jump up because, you know, something happens in US, you know, like the other day, yesterday, market just suddenly came down because of, you know, US and China trade war. So you always have gap like this, you know, when you're trading outright. I mean, market open, jump up, market open, jump down. So, but I never like this kind of market, because it never actually give me good result. I remember most of the time when market go gap up or gap down, it's always go against me. So to me, I rather market don't have gap. So how is possible? It is possible if it spreads. For example, in this particular day, you see that the market actually gapped down 50 points. But what happened in the spread market? The spread market has got no gap at all for that particular day. So there's no gap compared to outright. Because spread go up together, come down together, so you don't have a gap. So I rarely seen any gap in trading spread, especially those active month. So to me, this is actually advantage to me, because I have a very predictable market open for the next day. And spread also actually give you some what we call the advantage, because during trading, the spread actually allows some rollover. There are some traders actually who trade outright position, especially hedgers. They may be trading hundreds of thousands of lots. Okay, what they do is actually they need to roll over every month for their position. So whenever they trade outright, so they need to actually do rollover. So these are the volume by rollover. You see, in spread trading, you can actually trade up to hundreds of lots in one trade, which you hardly see in outright trading. Or those you can see in outright trading is actually done by spread. So that's how spread actually works, and it works in size, because that means if you're holding 100 lots of spreads, you actually can be filled and you can be traded. If you have holding 500 lots in outrights, maybe you need to roll already, because you maybe cannot have all your order field. So the next thing on trading spread is because spread has been trading by most of the professional. So it's actually a shortcut to trade like a professional, because it is self-explanatory, because why most of the professional or full-time trader trading spread, because it has got higher chance to survive in turbulent market, because something that go up violently, it doesn't affect you as bad as actually spread outright. Of course, you can argue that I want volatility, because volatility is the one that I want to trade, and make a lot of money. But you know that actually, whatever that you volatility that you want is actually a double whammy, because it could actually make you rich, but it could same time actually kills you or make you poor. So that's why, as a professional trader, which we need to generate income actually from trading. So this is what we need. We need something that we can trade a lot, and much stable, lower the risk, and so on. So with this, actually, I also show some example, which is the real example, and some strategy that we could actually relate to. So first thing first, this is again the same or similar time, where you see now the August, this is the time traded. And do you know that actually a spread trader, you can actually ignore the price of outright. This is outright prices. This is actually August, September, October, November, December. So all we remember will be August, or what we actually trading are, we are trading the August Sep, which is -1. We're trading September, October, which is -6. We're trading October, November, -16. We're trading November, December, -29. We are trading December, January, -39. That's more, okay? And sometimes, maybe I have to admit, most of the time, actually, we don't know what exactly is the CPO outright price close today. But we could remember all the price of the difference of two contracts. That means we will remember the difference, which is the spread price of two contracts, but we hardly actually know, or do we really actually care about the outright price. So this is how actually we trading this spread. Okay, move on to the next slide. Is all right. Now you can see the same type of configuration. This is how we look at prices. We call this refractor. If you're using JTrader or any compatible platform, you see this. This is the selling side. Okay, this is the buying side. But we don't look at this contract, because I'm not trading outright. Okay, we also don't look at this. We are looking at only the one that in the center. And we actually open only this one, but of course we're not opening only one contract. Usually a typical spread trader will have 10, 20, or even 30 or 40 refractor of different months open. This is how we trade. I could have been, let's say I buy -2, I sell at 0. That's all. That's how I trade. And this -2 and 0 doesn't mean probably a actual good number for anybody. It's just a figure. But of course, if you study it correctly, the spread is actually representing the demand, supply, and all the fundamental of the CPO prices. But in actual trading, we could actually forget all about this and be purely trading with probably mathematics. So take a look another screen. Okay, let me show to you. So this is another example. It's actually trading at same level, but the spread actually remains, a lot of orders parked. You can see thousands of contracts or lots trading, or traders are parked there. So let me show you some price where spread in action. You can see that this is a time and sell. You can actually see. All right, a lot of actually prices done is actually, let's say someone sell a contract in this one, okay, this price, but actually they are actually, who is the buyer when someone sell? The buyer can be not another hour trader. The buyer can be a spread trader. In this case, you can see the timestamp. They are in the same time. It means one thing. That means the seller who sell to a spread price, and the spread price actually capture the price. And this is how I say, well, what I said, that spread trader actually provide liquidity to the market using this method. All right. Now, I know most of us love charts. Although most spread traders don't trade with chart, okay? But do I look at chart? Yes. Why I look at chart? Because you look at chart, you have advantage. For example, you know where is the low, where is the high, where is the trend line, and you can also look at what is the trading signal, by indicator, technical indicator, and so on and so forth. So you could still trade spread like an hour contract. It's just that it could actually move about 10 times slower. So if you are typical technical chartist, which you want to try out spread, you could actually trade spread just like an any individual contract or instrument. They just work as good, just that it moves much slower. So it still has got a lot of range for you to trade. Okay, for example, this is one of the example. Last year, actually, due to El Nino, spread actually went very volatile and went up to 200 over. So if you look at trend, but it doesn't happen all the time. As I said, most of the time spread is actually sideways. If you look at trend, probably spread is actually not the most best choice for you, but it could have this kind of trade. You can still trade with, let's say, 5 minutes chart, 15 minutes chart with technical indicator, which is not my best part. My best part is actually we trading like just numbers. We sell at probably the resistance, we buy at the support, and this is how I trade. Or I could have looked at maybe intraday scalping for 3-4 ticks, that kind of trading. But this is still very much possible. But as I said, because we are more trading like short term, so that's why we try to just capture the 3-4 points will do. And last but not least is you can actually, as I said, spread trading is one of the strategy already. Spread trading is actually classified as a strategy, but there are more strategy you can derive from spread. Is you trade 2 outright contract, you combine, you get a spread, okay? But you combine more and more spreads, you will get butterflies, you get iron condor. And these two codes are actually created last year by Bursa. That means now you can trade butterfly. Last time when we want to trade butterfly, you have to scratch your head, you have to plot your own strategy. When should long this, sell this, buy this, that to build a butterfly. But nowadays, Bursa has got, one of the very good tool. That means whenever you're trading butterfly, whenever you're trading CPU, you can open up a strategy view, which you have spread, you have butterfly as well, and you also have iron condor. But iron condor is actually not so active in Malaysia, but butterfly is actually quite active nowadays. So you can trade this kind of strategy in trading futures. And again, why trading all this strategy? This is a $1 million question. Again, it's all come into risk. Okay, you have better chance to survive in a turbulent market. I've been in this industry for some time. I have heard so many good stories, which a beginner trader maybe take up 10,000, he make tens up to 100,000 also. I heard recently, actually recently. That means you fuck up probably 10,000, you make 100,000, which is a lot of money you make because you make some good trades, okay, and the market trend. But how long can this kind of trade survive? Usually, I heard a very sad story is that usually the trade actually went sour eventually, and this trader may actually lose some money because the market is actually not fixed. Let's say if this pattern has been there for probably 2 months, 3 months, you make money, and you think that market can continue for another 2-3 months, which is actually curve fitting. So it does when it doesn't work, it went against you, and if you don't have a risk management intact, or you have been not trained with risk management in mind, then you could actually lose money. But spread is actually much higher chance to survive. So when you survive, you trade long enough, that's how you learn. That's how you actually practice yourself to become a profitable trader. And because you're trading both sides, okay, you actually sort of actually take out the directional from your trading. That means you don't trade directional anymore. And to manage a losing position, only spread actually allow you to manage losing position. What is actually manage a losing position? Managing a losing position is actually that means you have a bad position. We don't cut loss. We actually we throw in some other contracts to actually manage the position. So to allow us to actually repair, recover, or even sometimes we could actually make some money out of a very bad contract or position. And this way actually eliminates the cut loss approach. You know, who wants to be cutting losses? You know, whenever I have a bad position, I will tell myself, or I'll tell you, oh, I'm losing money in this position, but it's okay because I have hedged this and that. So when I'm telling you I'm hedging, so I sound like professional, right? So yeah, so I don't sound like you know, I want to cut loss and I feel bad, you know. So yeah, that actually one of the important element of trading spread. And you can extend this kind of knowledge of spread trading to other trading as well, because a lot of people actually trading spread, but you may not be aware of it. Let's say, for example, you may be selling let's say soybean oil or bean oil in US seaboard, and you're buying palm oil in Malaysia. So this all are cross-border arbitraging. You actually buy Japanese yen, you sell US dollar. These are all spread as well. So, and most importantly, because it has been adopted by professionals for many years, it's so-called proven strategy, which actually it was kept unknown for so long. But we ran a series for the past few years, actually, so that to explain in depth. In fact, we have a seminar or webinar also explain this. You all can actually check out this in my website as well, so that you know you can actually have better understanding of why this is actually uses and why this is actually kept secret for so many years. But we have run through so many series. I don't know how many times I've been talking about spread during seminar or webinar, just to actually explain to everyone. You can actually trade spreads just like any other full-time trader. So with this, I end tonight's webinar. I know that there are going to be a lot of questions. I try to answer my best to all the questions. Hopefully we have enough time, and I'll probably pass back the Q&A to the host, Chun Sam.
Hi, thank you very much, CC. And we are now going for questions. Now, you have any questions, can write in the chat box. And while we were doing this, writing down the questions, can we do something interactive and fun, which is I want to launch a poll. And the poll says that, do you have a futures account? All right, please select one. Yes, I'm an existing trader. Yes, but I've never traded. No, I'm interested to open one. No, I'm not ready yet. All right, you can please click so that we know who, whether you are already a trader or you are not a trader. Okay. In the meantime, you can type your questions in the question box. Okay, we have 78% of you voted. Alright. Who else not yet vote? Before we close the poll in 5 more seconds. Okay, cool. We're gonna close the poll now. Want to see the result? Here is the result. Okay, we have 46% of you are already a trader, 20% of you have a futures trading account but never traded, 15% of you are interested to open one, 20% are not yet ready. Alright, no problem. So, well, we are going to hide the poll, and then we are going to start talking, answering your questions. Okay, so the first question is it one CPO contract cost 4,500?
Okay. When I say worth, then I'll usually refer to the contract value, which is no. But one CPU contract is actually needed about 4,500, exactly 4,500 to control it. That means you need to put in 4,500 in your account in order for you to buy or sell one contract and hold it overnight. The exchange need you to have at least 4,500 ringgit in your account. But how much is the contract worth? The contract worth varies. So usually it's the value of the CPO price multiple by 25. If let's say the CPO price is actually 2,400 and times 25 means 60,000 worth of contract. That means you're using 4,500 margin, okay, to control 60,000. That means just like buying stock, you buy a stock worth 60,000, but you don't need to pay 60,000. You only need to put in 4,500 only until you close the position. That is how the margin actually works.
Okay, let's go to another question. How do we roll over a FCPO spread trade?
Grow over?
Roll
Roll
over.
over?
Yeah, roll over.
Okay, rollover basically is actually for the outright trader. Let's say, for example, you think the market can go down. Let's say just now I have a slide showing you final lots people are selling or buying. So let's say if you're holding, like right now it's August, let's say for example, you sell August 500 lots. In order for you to roll, let's say for example, yes, you sold 500 lots in August. Okay, in order for you to roll this contract to next month, so what you want is you buy 500 lots in August and you sell 500 lots in September. So with this, you actually cancel the August contract and you net you're holding 500 lots in in September. So you actually, once you do the buy spread is, you buy 500A and then you sell 500B. So you actually roll over your contract to September. From August, your position short 500 lots, and then after you buy the spread, you end up you have 500 lots short in your September, but your August actually closed already. So that's how you do the rollover in so-called outright trades. But if you want to do similar thing for spreads, let's say you have short 500 lots of spreads in August Sep. So what you can do is actually you can roll over by just close or buy 500 lots in your August Sep, and then you sell 500 in your September October. So you actually effectively you roll over your contract as well.
Okay. Now the next question is, based on experience, what should the person achieve for the average winning ratio to be profitable?
Winning ratio? Is it winning ratio?
Yes, correct. Winning ratio.
Okay. As
profitable.
Yeah, I as I just accidentally revealed my secret just now. The winning ratio minimum you need is actually 65%. So you need to at least have this percentage. Otherwise, your profit won't be profitable in long run. But if you have cut losses in your trading, you may not achieve this 65. 65% looks like very simple to achieve, right? Because default, you'll be awarded 50%. So you just need to add another 15% to get the 65. But 65% consistently for all year round is not easy. But to be very, very so-called confident that you can profitable in long run, you need much higher than 65. If you can get 70, 75% or even above, is actually very much needed for you to have the confidence every day. You see, trading is a very tricky business. Sometimes you buy here, sell here, you have no fear. Then you buy, sell, you make money. But after some drawdowns or some winning series of trades, you may have fear to do the same thing, even though the setup is actually exactly the same, but you wouldn't want to execute because you are so fearful of the previous experience. So that's why, in order to build that confidence, you need a good winning ratio. So good winning ratio need a very good strategy, which in spread, which you can actually make the spread. Try as much as possible not to lose even in a single trade. Okay, so how not to lose? One example I just told you was, try not to cut loss so often. Cutting loss is actually seems so logic to make money. You cut loss short, you let profit runs, but in reality, if you practice that too much, you can see your equity actually coming down rather than going up. So especially if you trade long enough, this is actually a bad thing. But if you're trading outright trading, that means the CPU outright trading, if you're not cutting losses, then it's even worse matter. So try to develop yourself to be able to hedge the position and be patient with the losing position. You can't hold an outright losing position so long. This is actually very important. Don't make me misunderstand that. But what I mean is actually spread position. When you're in a losing position of a spread position, try to manage it. But in first place, if you are trading outright, then how I'm going to manage it? Well, I just tell you also, if you're trading outright, turn your outright to a spread. Let's say if you buy a September, it's a losing position, so you sell October to turn it to a spread. Then from there, you calculate your spread difference and then you trade it like a spread. But in reality, for me, all my trades actually trading in spread because I don't want the hassle to go in out and all this. So yeah, you need to have very high percentage. Spread can achieve that, and 65 is actually the baseline you must achieve. That means go home and check probably how many the last 100 trades. Don't use 10, hundreds if not thousands to calculate how many percent winning. And winning, I mean winning. The thresh or break even don't count. Okay, just count the winning trades. Then you get the percentage that you probably needed.
I see. So in summary, don't cut loss too often in spread trading, but to manage your losing positions well. But in outright, no choice, have to cut loss.
Yeah, exactly.
That's what you say. Okay. Now, so next question is, how do you back test or forward test? Like, can you explain more? Like, what data you use?
All right. In a matter of fact, not much data available for spread, and then spread doesn't really work exactly the way you backtest the CC chart of, let's say, a CPU and all this, because spread don't actually has sometimes doesn't link. Let's say, for example, it may have a very big gap from one contract to another. So you don't have a CC contract, and spread has got so many contracts, and it doesn't work this way. So if you ask me, do I forward test or back test my spread trading? No. Do I back test or forward test my outright trading? Yes. But then how I actually get into trading spread? Because I have done so many forward tests. Actually, that means I don't really have a back test for spread, but I've done so much on the forward test, and I'm convinced this spread trading actually works. Because I've probably done I don't know how many 100,000 trades in CPO, so it actually works. But unfortunately, you don't have much data to test for your spread trading. But if you are interested, how I get started is actually I never have chance to went for any courses and class, because in the market I don't see anyone except me who teaching this spread. What I did was I actually collected my own data. I do my own calculation. I do my own records and all this. I try to actually derive some habit or patterns from it. But eventually, I've gone on tested trading myself, and my objectives never actually find a perfect system or trading signal. So I never really look into that. That's why I give myself a lot of room to be, make mistake or error. So that's how I get started trading spread, and it's allowed me to actually make mistakes. And after trading, I don't know, for a few years, you feel like you don't go for that back test, but I have already forward test with actually real money. So yeah, yes, back test for CPO. All right, no spread. I mean back test for spread trading, but I have done the forward test myself. So should I say I'm proud to say that spread trading is actually works. If you feel that you're not suitable for outright trading, you should actually trade spread. And trading spread in Malaysia is actually good for Malaysian because you don't have to go out and convert to USD, faces the currency loss and all this, and also support the local market because, yeah, you donate to Tabung Harapan, but supporting local brokers and exchange is actually one way to be patriotic as well to me lah.
Okay, all right. So that's how to be a patriotic. Huh? So now next, what is the purpose of the price curve?
All right. The price curve actually shows you whether the market is in contango or backwardation, but this is actually a bit complex
Technical,
lah.
yeah.
Okay. Yeah, a bit technical. But basically, when I look at the price curve, I know that what strategy to use for this market. If you're trading long enough, you should have experience enough, or your records is actually can shows you, okay, during a contango market, what you do. Let's say during a bear market, how the price curve looks like. So from there, you know that you should actually do a bear spread or you do a long bull spread. So, but this is actually just probably 10% of your trading. But at least you know what to do by using the price curve.
Okay, so that's the purpose, is to see whether it's contango or the backwardation. Yeah. So now, with so big orders, would it be difficult to get fill?
Not at all. Not at all. You can see just now, I just give you an example, a snapshot. The order was taken like 1,500 lots just in matter of seconds, So especially rollovers. And then sometimes that 500 lots, 400 lots, there are some traders actually cancel the orders. They want a better price. So my experience is that the order that I park, it can be get filled. Even I'm behind them, like I'm the number 600, I still able to get filled. And sometimes after I park for a few days, when I park, I know that I'm the number 600, but the next day when the price hit, I'm number 1. So I don't know, someone must be cancelled and put back the order, or push me into front, so make me thought that I'm the number 600, but actually I'm the number 1. But I usually trade with my own strategy, so there's different type of trading. In my company, I have some traders that track this kind of moment. So which usually they do quite directional intraday trading. So I can't be too active because I have to oversee all my traders as well as I'm trading for myself. So what I do is actually I'm more on a strategy base. So I usually park in the prices I wanted and I let my order fill. So I wouldn't have problem getting order filled. I may at time I wanted the price never filled. Then I try to find some way or somehow to probably get my order repair or manage any position that I may be losing money.
Like, do you trade every day, or there are some days when your orders didn't get filled, you just let it pass by like that?
Usually I get traded every day. I consider myself very, very hardworking. A lot of people actually say that I have so many traders, maybe I'd be very easy, no, I don't need to trade every day. In the matter of fact, quite the opposite. I'm the one who traded a lot, and I'm the one who actually quite busy because as I said, I had to look into their trades and also assess the risk. So I get myself very busy, but I still have orders fills almost every day. But you're right, if sometimes the market is too quiet, let's say for example, for whatever reason, if I don't have an order fill or done for that particular day, I'm okay. But I have no experience that either me or combined with my company or my traders, we have no order fills, which I have never experienced before. That means either my order fills or they have orders fills. So every day we trade quite actively. But if I don't have order fills for that particular day, I'm okay.
Okay. Now, so the next question is, when you hedge, right, are you saying that you're actually cutting losses?
When I hedge, actually, I don't cut loss because the position that I have originally that losing money, I'm still owning it. In fact, I have so much experience that the losing position I may actually keep for 1 month or 3 weeks, and I have trading others, the hedging, keep on doing the hedging, then quite do the opposite. I maybe temporarily take out the losing position, then I reinsert it back. I do quite a complex mechanical trading. Doing a lot of things. At the end, after 1 month, the price maybe actually come back to me, or the hedging that help me to cover all the losses. Then I'll just close the position. So when I'm hedge, I actually don't cut loss. So yeah, quite the opposite.
Okay.
I really mean I didn't cut.
I see. So when you do spread trading, are you actually putting 2 orders in the market, or is just that means you buy one near term? Let's say you buy one near term contract and sell the 5-month contract.
Yeah.
So you need to place 2 orders lah.
No, I only do 1 order.
That means there's one order that when you click buy or sell, then it will simultaneously help you buy.
It's a spread order.
It's a spread order, so it's only one time.
Yes. Yes.
So don't have to put.
I hardly do the leg in. You can do that, but sometimes you may have what we call it's actually slippage. So you want to get price of 1, but you end up probably getting 2. So you actually slippage of 1 or 2 ringgit. Then it's disadvantage already, because to me, if I'm trading intraday, 2-3 ticks is actually enough profit for my trade for that particular day. So yeah, usually I don't do that. No, I say I don't do that. I will just go in using the spread code available and do it simultaneously.
Okay, that means the brokerage fee only charge you once.
No, not really. Okay, because your order go in is actually still 2 legs, so you still get charged by double. That means if you trade outright, you buy 1 contract, you pay 10 ringgit. So if you trade 1 lot spread, you actually paying 20 ringgit. That means 1 buy, 1 short. But of course, when you're trading spreads, your volume increase. So most likely your broker will be quite friendly to you, and they will actually have better brokerage for any spread trader. And also, if you're trading spread, also you need to have a broker that supports spread margin, because somehow the system may not recognize spread margin and outright margin. So you need to have the broker, or you have to inform your broker you are trading spread rather than outright.
Okay, so what is your entry rule? Like when you see what kind of situation or how does your strategy allow you to enter the market, and how do you exit the market?
It's a very tough question to answer probably in 10 minutes. The setup wise, it can be a very complex thing, but it can be very simple as well. Let's say I have a friend always joke with me. He says spread trader is good because you can go in long or short anything you want. So don't bet with a spread trader. You dare to go in long or short, because we can go in any direction first, because it's a spread trading. So if you put in an order long or short, it wouldn't be wrong, immediately. So how I actually put up an entry is sometimes when I have no position, then I have to depend on the price curve. Let's say I need to know where is a price, just like trading stocks, where is the bottom, where is the top, or support and resistance. So usually if I have no position, I'll park there. Or if I know that the market will go into that support level for some reason. So I will actually probably do the opposite, to sell to the support or to buy to the resistance. So that is, but I don't mind. I need to get a very good price. I can go in a price that not really good. Let's say, for example, I'm the type of person that if I buy something at 10, okay, the price go down to 5. Will I buy? I'll say yes, because since I'm willing to buy at 10, why don't I buy at 5 as well? Because 5 is actually much cheaper. But that means I'm average down. Spread is actually allow you to trade this kind of way, but not without risk lah, not without risk. So, okay, back to the question. The simple answer is actually I can go in long or short as long as I know how much money I lose. So let's say if I go in any direction you want me to go in, I'll put myself 4 points risk. Let's say maximum I lost 4 points. So 4 points I either cut or hedge. So I can go in, but I wouldn't go in just blindly. So usually you find me most likely near the support or the recent support or the recent resistance. As well as actually I might have a strategy that, let's say, I can see the price, certain price actually going down, certain price are actually not moving. I maybe sell the one that's strong, or I maybe actually buy the one that weak. I maybe actually do the opposite, so it has got probably 1,000 conditions, which very hard to actually really like explain here. But maybe I would suggest this way is, my trading totally allow me to make mistakes. That means I don't believe someone will ever invented a system or method to buy and sell at a perfect bottom and peak. So I will never look for this kind of perfect trades, because your order will never get filled, or if it's get filled, you may not go in a size that big enough for you to make some money. So what I will say is that since I allow myself to trade in, the market can go against me, so I will actually carefully trade. I usually do in a very small size first. Okay, that's how I go in. So I'll never have fear to go in or enter any direction. But of course, maybe I also suggest another element which always in my mind. So I have actually few things in my mind which I'm a discretionary trader. That means I trade based on my mindset, but I also have some mechanical rules that I follow, which is let's say all the risks, all those are fixed. I never bend my rules for risk management. So another thing that probably you can actually try is the seasonal patterns of the commodity. So that means production picking up is actually an issue, okay, or the stocks going up or stock coming down. So you will receive all this data. Based on this data, try to make a guess whether the price curve will go in the bull spread or back rotation or actually a contango. So this could be a few elements. So I have very fixed rules of risk management, but I have very flexible mind for me to go in. So because I'm a discretionary trader by nature.
Okay. I have a very interesting analogy by one of the participants. He said that spread trading is like driving a car with one leg on the brake and another on the accelerator. Very stressful to be the driver and engineer. Are you and you'll get to the destination slower. Do you agree? That's this question.
Very stressed. I don't agree.
Yeah, I mean, do you agree with the analogy by we drive a car, you one leg press the accelerator, one leg press the brake? Yeah, that's the question. Do you agree with this statement?
Yeah, it's almost like that. Or maybe it's actually very closely related to one on the accelerator, another one on the brake. So it slows down the cars. This car is actually moving very fast. Let's say, for example, you're driving a car that's very fast, which is outright CPO. It's actually probably 500 horsepower, which ordinary people like me can't control, right? But if you're driving a car like this, then with a brake applied, so I can control the 500 horsepower car. So I will reach the destination But most of the one who only on the accelerator and with the high 500 horsepower, probably they sideways, they oversteer, they understeers, and they may not make to the end of the point. But usually I will have this analogy is that spread trading, because you're applying brakes to this vehicle, it means that the car or the instrument move 10 times slower. By my calculation, it's about 10 times slower. So if I can slow down the instrument by 10 times slower, okay, that means I make myself relatively think 10 times faster, right? So let's say if I'm fighting with another person and I cast a spell, that person will actually move 10 times slower than me. So if each of us punch each other by 10 times, the moment he punched me, I already punched him 10 times. Do you think that he can still punch me? No, right? Because he already kena 10 times already. So yeah, it's almost like that. But maybe I don't agree whether it's stress in terms of the driver. For me, I have no stress trading spread or less stress trading spreads because of that. You see, I could be holding a lot of position that maybe not making money, losing money, but I can still sleep at night because I know that I know what to do tomorrow. And if the market just reverse, I know it's actually going to be favor me, or by my guess lah. But if I'm still wrong, so I know that something that I didn't do is actually correct. So I will do the opposite. So yeah, it's slower, but surely it can arrive. But you see, trading one lots of outrights, the price go up from, let's say for example, go up 50 points, right? So you make money. But you're trading spreads, in order to get the 50 points, what you can do is actually you're trading probably the spread actually go up 5 ticks. But you trade 10 lots, then you get 50 points as well. But of course the comp will be much higher trading this way. But yeah, you both actually get the 50 points at the end of the day.
Okay. So the next question is, does the mean reversion technique work when trading CPO spread, or basically the spread will return to the normal level in the long run?
It works. The only problem is actually you do not know exactly where is the mean. It works, but the mean the mean is actually not in zero. The mean is actually quite fluctuate. But I do not really detect the mean, or I'm trying to discover the mean. Actually, the price you're right in one sense, is the price of the spread is actually trying to discover the mean. The mean probably over 10 days, you can see that is one particular price curve. It always stays there, which is the mean. But you will only know after the market, probably few days later. But you can always guess this could be the mean, then what I can do. So let's say if the price deviated from the mean, above the mean, then you sell. Then if it's below the mean, then you do a buy. But this is actually could be dangerous as well, because when the mean actually deviated from the mean, it could actually tear or widen to a stage that it never come back, or it doesn't come back so much, or it will tear actually to an extent that you may actually not enough money to hold the position. So once in a while this could happen, so be careful with this kind of trading. But you're right, I still almost like try to trade this kind of mean reversion. Just that you will never, as I said, you never get it correct all the time. But yeah, if you can get it 65% of the time, good enough, right?
Okay. Then do you get margin call if the direction is against you? Like if one trades spread, right, the positions would be large, and so we need to have enough reserve to avoid the margin call?
To avoid the margin call, definitely, if you're trading any instrument, you need to avoid margin call. If I remember correctly, me and my company, we have never been margin call, because I'm the one who actually look up the margin. I make sure myself, all my traders, they have no way for them to actually reach the level. Let's say you need the margin to hold position, but then you need excess buffer to allow the market to frustrated that you are not actually margin call. No, I never margin call. And I will avoid that. Yes, you need more money than that 1,002 to actually avoid margin call, definitely. So if you know my students or my traders or my students, I have a formula for them to calculate how many positions they can go in with the margin that they put in. So usually you free more money, equity, so that to avoid this kind of embarrassed situation.
Okay. The next question is, when do you often open a calendar spread position by buying the spread, and when do you actually open the position by selling the spread?
When I buy and when I sell, isn't it? I don't quite get the exact meaning.
I think he's asking like, is it like what the previous question is like? Is it one time click or need to click 2 times? Like
Oh
when you
yeah,
click buy,
yeah.
immediately click
Using
sell.
the spread. Yeah.
Yeah. Okay.
Yeah, it's immediate. I open up the codes, which is I trade the difference. You see the 2,500 something, 2,400 something. You know, I never traded that in my actual trading instrument. What I see is probably I can go back to one of the slides, okay, to make this easier to understand. You see, I'm trading this. I'm trading this. I'm trading this number. I'm trading -1. I buy -1, -3. I sell 0, sell 1, sell 2. So I don't know the exact price of outright. I trade the spread price only. Yes.
Okay. So now the next question: is it a good strategy to buy long spot month spread instead of sell spot month spread?
Buy long spot month spread. Okay. First thing first, CPO do not trade spot month. Okay. FKI, yes, you can. Probably your question will be long near, sell far, or sell far, long near. As I said, this is actually depends on whether it's contango turning to backwardation or backwardation turning to contango, which actually a bull spread will be you long near, sell far. A bear spread is actually you sell far, buy sell near, buy far. But of course, you see, like any other market, the price want to go down, it will shoot up first, then before it go down. Don't know for why. Okay, so you will never guess correctly the timing. You may guess once or twice correctly, but out of 10 times, maybe 5 times you'll be that wrong. So if you're wrong, what to do? So which is more important? So buy spot, sell the other one. I'm not so sure this is actually the way. So it's always a pattern. Okay, there's certain months the spread will go up. There's certain months the spread will come down because of rollover, because of the seasonal change and all this. Yeah, it's not a strict answer that you can get this correct, but yeah, if you know that you're going to do a bull spread or bear spread, then roughly you know how this can be done.
Okay, yeah. So I just want to clarify on the previous questions about the buy or sell, because the participants clarified. His question is actually, when do we buy the spread when in contango or sell when it's backwardation?
Okay. Maybe we think too far. Okay. When you're trading contango and backwardation kind of terms, you're trading very long term. You could be trading like, you know, the market from contango turn to backwardation and vice versa. But you see, I didn't trade so long because from one contango to backwardation, it could take like 6 months. Okay, I don't think I hold position so long. Usually, if I can hold 6 minutes, I'll be just sell. Let's say if buy now, 6 seconds later or 6 minutes later, someone want to take my price. I sell back to him or her. Yeah, I'm happy to do that. So I trade mostly, you know, if possible, intraday. If I'm holding a position, I could be like days. If I'm holding position more than 1 week, means the position not making money lah. So 2-3 weeks maximum, or worst 1 month. I think I never hold a contract more than 1 month. It's actually with this kind of trading short terms, you don't need to really hold when it's back rotation. Probably you hold a long, and the contango you hold a short or wrong. So I don't think you need to consider that just for start. Don't do that. Try to, if possible, look for 2-3 points profit. Try to look at the spread price long enough, okay? Then you start spot where is long and short. You know how I started trading spreads? I try probably 2 ticks, 3 ticks, 4 ticks. If I make money, I'll be quite happy because I don't know how it works, but I tested it and it works this way. So yeah, try with this kind of smaller range. With the smaller range, we call scalping. Then you don't need a direction. You see, I know a lot of professional traders, big volume one, usually trade spread. But I also know some traders, they're profitable trader, but they are not trading spread, they're trading outrights. You know how they survive in trading outrights? They're trading scalping. That means they will take 1 tick, 2 ticks, 1 tick, 2 ticks in outrights. That's how they scalp. But if they can scalp 100 ticks a day, they make money. They make quite a lot of money. So same thing, you're doing spread, you can do scalping. But when the scalping goes wrong, then you try to look at the contango, the price curve, to do a strategy, whether you go for a hedge, or you want to turn a butterfly, or you want to turn to an iron condor to hedge your position, to get out from this losing position. This is actually probably is what I'm doing almost every day.
I see. All right. So that would be our last questions because we have reached 10 o'clock. So, well, I want to thank all of you for coming to this program, this webinar. And now let's talk about our next webinar. Our next webinar will talk about outright strategies. For the past 2 webinars, we've been talking about spread tradings. And then the next webinar, we'll explore why you should do outright and how is outright work. And then you see which one actually suit you better. So it is on the 18th of July, 8:30 to 10 p.m. This is the registration link. Let me send it in the chat group. So, alright, I'm sending over the link for the chat group. So if you want to join our KLCF futures trading strategy for outright strategies, please register at the link in the chat group. Okay, with that, thank you very much, CC Yong, for spending your precious evening with us to teach us how to get started. And before that, I just remember there's one question to ask us: do you do any class or not, CC? So can you quickly answer this question?
Oh yeah, for those who are interested, you can always go to my website in straitsindex.com. Or you can request for the video of the previous introduction class for this class. Yes, I do, and please contact me via the website or the contacts in the website. So it's just easy, straitsindex.com. Just Google, most likely you land into the correct page.
All right, thank you very much. So just go to straitsindex.com if you want to learn more about Ms. CC Yong's class. With that, thank you very much for being a wonderful audience today and asking so many questions that are of really good quality. I'm very blessed to have your questions here so that we can have educational and interactive sessions. With that, thank you very much and have a pleasant rest of the day. I will see you in the next webinar in July. Bye-bye.
Thanks. Good night.